Good morning. Let's go ahead and get started. I'm Barb Cooper. I'm president of the Austin Board of Realtors. I'd like to welcome all of you here. Thank you. How many of you are attending one of our forums for the first time? Thank you all for coming. This is a very important topic, so I'm glad that you're all here. I'm glad that we have a panel of experts to provide you with really timely, meaningful information to help you in your business in the coming months, which are going to be crazy. Also, rest assured that the Austin Board will be offering multiple classes on this new, on the CFPB, just so that we have highly educated agents. You know, the MLS is about cooperation, not just for our commissions, but working together, holding a deal together. And I think with the changes that are coming in the next few months, we're really going to need to have cooperation amongst agents. So let's make sure that everybody's educated and working together on that. Very quickly, if I could ask any of our ABoR directors, past presidents, committee chairs to please stand, just say hello to them. There's a number in the room. Thank you guys for being here. A couple of housekeeping items I wanted to let you guys know about. We are in the process of, we're going to begin construction next week, to add a turn lane to come into the building. So there's going to be a little bit of disruption, but it's going to be worth it in the end. We'll do our very best to notify you of days when it's going to be a little bit more hectic than others, but you will be notified, so that's coming. Speaking of parking, I want to thank all of you that carpooled today. Those that did entered to win gift cards to Galaxy Cafe, which just opened around the corner. And so when we have large events like this, we do want to encourage you guys to carpool. So you must be present to win on that one, if I can add that. So stay for the whole thing. You guys are going to get tons of information anyways, you will. I do want to mention that June 30th is the deadline for anybody that wants to apply for a leadership position at the board. So please be sure to do that. All of that information is on abor.com. Also, we have our Tree Pack movie night at the Bob Bullock Theater on June 30th. It's the sneak peek at the new Terminator movie, and so that is for the Tree Pack investors. We do have a deal for you. If you have never invested in Tree Pack, which is investing in your profession, Bill Evans is selling tickets 2 for 1. Do your first time Tree Pack investment and go see that movie on June 30th. You can see him at the end of the program. Okay, and then the last thing, I do want to thank Austin Title for showing up in force, bringing a lot of really talented people, putting together this panel, and for sponsoring this event. And with that, I'd like to turn it over to Roxanne Ford, who's the VP, sorry, of Business Development. You know, what's fun for me is that there are so many people in this room that we've all done business with for years, and sometimes you stumble over somebody's name because you pull out their maiden name or you knew them from way back when. But anyways, I want to turn it over to Roxanne. Come on up.
Good morning, everyone. Thank you so much. On behalf of Austin Title, we're so happy all of you are here. We're all here today to learn more about the biggest changes to hit our industry in decades. And as a member of the largest title company in the world, Austin Title wants to help prepare you for the upcoming changes. Our motto is know before you close, and we take this very seriously. We're here to not only protect and educate our clients, but also the consumer. We think the new rule will bring more clarity about the mortgage process. And to consumers, so sorry everyone, I got nervous all of a sudden. To consumers, we want to partner with you to make sure October 1st is a seamless transition for all. There will be an open Q&A, so feel free to text your questions. It is going to come to my phone, 512-771-1195. We are going to have that on the screen for throughout the presentation. So as your questions arise, please text them. We're going to have probably more the latter part of the panel to where we will then open up to all of those questions. So I'm going to go ahead now and take this opportunity to introduce our panel of experts. First, John McClellan, John is the branch manager of Supreme Lending. He's a true professional with a passion, over 18 years experience in the real estate and mortgage business in Central Texas. I'm sure many of you also know John from his weekly radio show on KLBJ-AM, The Real Estate Zone. Kayleen Beck, loan originator with our bank. Kayleen started her mortgage career in Jacksonville, Florida in 1994 and moved to Austin in 2003. She joined our bank in 2013 and loves being a part of a small community bank and lender. Linda Randall, down there at the end. Realtor and Trek provider, a Trek instructor for her own classes as well as legal updates and ethics. I'm sure many of you in this room have been educated by Linda at some point. She's an active licensed realtor and a longtime member of ABoR. Chris Baca. Chris is an attorney with Beatles, Newman, and Lawler. His firm offers legal services in mortgage lending and residential real estate transactions. Chris brings years of mortgage and financial institution compliance experience. And next, Dawn Partington. Dawn serves as Executive Vice President, Legal and Strategic Affairs for Fidelity National Title Group. This is our parent company at Austin Title, and we're very proud of that and very proud for Dawn to be able to be here. He's responsible for the coordination of our company's strategic product and process development. Most recently, Dawn is a member of the American Land Title Association Task Force on implementation of the new CFPB proposed regulations on combining disclosures under TILA and RESPA. He's also made presentations at HUD, congressional panels, and the Office of Management and Budget on RESPA. It goes on and on. I want to say that just yesterday, Don was in Denver on the ALTA board up until about 5 o'clock, and he caught a plane last night to be here this morning. So thank you so much for that. So without further ado, yes. I think when he's not on panels, he's on an airplane, clearly. So, and last but certainly not least, our fearless leader, Josh Williams. He's the president of Austin Title and today's moderator. Thank you, Josh.
See if I can turn this on. Can y'all hear me okay? I feel a little like Phil Collins with this thing on. If I break into a Susu studio, y'all just go with it. Thank you again for being here. Obviously here to discuss a very important and timely topic. We have a whole lot of ground to cover this morning and very little time to do it, so I'm just going to jump right into it. So CFPB, what is it? How did it come about? The Consumer Financial Protection Bureau, which is a mouthful, was formed in July of 2011 and was authorized by the Dodd-Frank Act, which, if y'all remember, was Obama's response to, or his legislative response to the 2008 financial crisis. And when forming CFPB, they had in mind for them to be tasked with promoting fairness and transparency for creditors or financial institutions. And their jurisdiction includes mortgage companies, banks, lenders, securities firms, everything from credit card companies, student loans, car loans, the list goes on and on. But they have made it very clear that their top priority is mortgages, student loans, and credit cards starting out. And of course, we're here to talk about the mortgage side of that. And as far as the mortgage companies are concerned, CFPB has come out with some new rules that originally were to go into effect August 1st. As I'm sure many of you have heard, they have proposed a new date of October 1st. And they're allowing the public to respond to that before they make the final decision on that. But the new rules that CFPB has put into place include, but are not limited to, combining some new forms, which we'll get into great detail about here shortly. But their goal is to protect the consumer and ensure that there are no surprises at the closing table. And as far as the forms are concerned, they felt like going from GFE to HUD-1 at the closing table, there wasn't enough consistency there in forms, and consumers couldn't really compare the forms apples to apples. They looked very different. So what they've done is taken the early TILA and the good faith estimate and combined them to make the loan estimate, and they have combined the final TILA and the HUD-1 to form the closing disclosure. They have also set some guidelines as to when creditors have to deliver these documents and how long the consumer has to review it before consummation, which is a new term that we'll discuss later. Before we get into the detail, I want to roll a video that I think explains the gist of this from kind of a 32,000-foot view much better than I did. So Felicia here is going to cue that. Felicia is one of our brand new sales reps. She is out in the Round Rock area, so y'all say hello to Felicia. Hi, Felicia. We need some volume on that.
Lenders to provide several different disclosure forms from several different agencies.
Yeah, let's start that over. Thanks, Felicia.
Federal law requires all lenders to provide several different disclosure forms from several different agencies to anyone applying for a mortgage. The problem is, these forms are kind of similar, but a little bit different, and most people don't really understand them. So, to simplify things, the government, through a bill called the Dodd-Frank Act, created the Consumer Financial Protection Bureau, or CFPB for short, to ensure that only one agency is accountable and responsible for protecting consumers. The goal was to make sure the new disclosure forms aren't confusing, that people understand what they're signing and what fees they're paying, and that they know their options to shop and compare certain services. In other words, no more surprises at closing. Okay, so here's what's new. The CFPB eliminated the good faith estimate and the early TILA form and introduced a new loan estimate. They also ditched the HUD-1 settlement statement and final TILA form and replaced those with a brand new closing disclosure form. And voila. And finally, there are new rules about when these forms must be delivered and how long consumers have to review them. These changes take effect August 1st, 2015. So make sure you know before you close. Forms, dates, rules, and laws, it can seem like a lot to take in, right? Well, the good news is that we've done our homework, and we're here to guide you through. To learn more about how the CFPB changes impact you, contact a local representative.
I just want to mention this and a whole slew of videos on CFPB and other topics are available on our website at austentitle.com. So obviously a lot of new forms, a lot of new rules. So we have gathered a group of experts in their field to get kind of granular on it, get into the weeds and talk in detail about it. We've got a mortgage banker, we have a lender, we have a title expert, we have an attorney, and we have a realtor. So let's jump right into it. I'm going to address this first question to the whole panel. So John, if you want to start. Let's talk about the new proposed date. Can you kind of help the audience understand why it's being proposed and what it means exactly? And don't be afraid to throw in your opinion as to whether it was a good move or maybe just delaying the inevitable.
Sure. So first of all, I want to say thank you guys for coming today. I want to thank the Austin Board of Realtors and Austin Title for throwing this today. It's a good time to be educated about what's happening in our industry, and I think the turnout here shows that. I want to go on record as saying I think that these changes that the CFPB has proposed for this new rule are actually a good thing. There are some inconsistencies in the current good faith estimate and the current truth in lending that are not helpful to a buyer, and I think you have some questions about that here in a few minutes I'll go over. So I think it's a good thing, but I do know that the rule was supposed to go into effect August 1st. They are now, looks like it's going to be October 1st. We'll have to wait and see if that's finalized, but I have a feeling that it is going to be the October 1st date.
Kayleen, anything to add to that?
No, I mean, it's a good thing. Anything that's going to protect. I mean, I know it's going to take a bump for us just to get used to how it's being done. But I mean, overall, it's going to be very streamlined for that borrower. What they're seeing in the beginning and what they're seeing at the end is going to be the same. There's no major confusion for them. So overall, it is a good thing. I mean, I think there's mixed reviews on whether it's being pushed back is a good thing or bad. I think a lot of us kind of want to just get it over with and be done and get started. But I think it was a little nerve-wracking, the fact that it was in August and there's still a lot of questions that need to be answered. So, but and cons.
John?
I have two things. One, on the forms themselves and the integration, I agree with John that there's a number of good things and a lot of good intentions from the CFPB for consumers. It will remain to be seen, in my mind, whether those become reality in doing that and how they're going to be implemented. I think the proof is going to be in its implementation on those. As to the October 1st date, I think it is a good thing. We have been asking, well, the industries, mortgage industry, title industry, and others, have been asking for some postponement or at least relaxed enforcement so that if you did these things and started out, you wouldn't be fined if you missed a few things along the way. I think that now they've moved it out a little bit to give us a little breathing room, especially in systems testing. I think that's going to be real critical for a lot of companies. When you're dealing in some of these things, a lot of systems have to talk to each other. And a lot of new systems had to be created to create the forms, create the various rules that we'll talk about that are there. So there's going to have to be some of that. And we never really had the time for testing in there, even though we had 19 months between the rules publication and it out there. So I think it's a good thing because it allows us to do a little bit more testing before we go into a live environment.
Chris?
And I also believe it. Can everyone hear me? No? All right. And I feel the same way. I believe it is a good thing overall, but what we have to remember is there's enough vagueness that enforcement and also how implementation, how everything's going to mirror or how everything's going to mesh together. So I believe that's going to be where we're going to find some confusion, especially in the beginning. But I think it'll all be ironed out once lenders get used to it, once title companies get used to it. But I believe that we won't really know enforcement-wise how everything's going to shake out until actually CFPB starts enforcing. And I just want to mention there's what I guess like an ironic situation with the reason why the CFPB pushed it back 2 months. From the sources that I've talked to, it was the failure to disclose to Congress about the rule change. The CFPB forgot to disclose to Congress. And they named that a clerical error, which caused the pushback. So it wasn't that the CFPB felt that they wanted to give us more time. It was that they had to, and they called it a clerical error, which is completely ironic. And I laughed for a long time after I read that and I don't think that CFPB would ever say that misdisclosure on the lender title side is a clerical error. And I'll leave it at that.
Linda?
I think from a realtor standpoint that selfishly here in our local area in Austin, this is our busiest time, and that was my concern that as an instructor and a provider and teaching all of you and trying to educate you and keep you up to date as best I can, that the time was just kind of critical for August 1. So I think all of us are looking forward to October 1st.
Thank you. So what aspect of CFPB do you foresee having the most significant effect on your day-to-day business? And John, I'll start with you again and go down the line.
The one that has the most significant, well, I think that's probably two-pronged, right? What has the most significant change for the consumer, and what has it for the mortgage company and title company? I'd probably want to start with the consumer itself. The current good faith estimate that was put out a few years ago, in my view, is woefully inadequate. Right now, the good faith estimate does not have cash to close. It does not show the full mortgage payment on it. It does not have a signature line. It does not clearly identify whether the loan is locked or not. I am very happy that they are replacing that document with the new loan estimate, which does have cash to close. It clearly labels whether your loan is locked or not locked. It actually has a signature page. And for buyers, the most important thing, it actually has the amount of cash to close that they have to bring to closing. I can't tell you how many times I've sent out a good faith estimate and the borrower asks me, where's my cash to close? Where is my full payment on this? And it's just not on the disclosure. So it wasn't very well thought out. So I think that the CFPB, when combining the current TIL and the current GFE into this new form, I think they absolutely got this right. So I think the biggest impact is going to be for the consumer up front is they're going to be more aware, and it's going to follow the letter of the rule, right, which is the know before you owe rule. I do want to comment about the Dodd-Frank Act, though.
Please,
right?
go ahead.
The Dodd-Frank Act has kind of been a bane to our existence over the last 4 or 5 years. So we prefer not to call it the Dodd-Frank Act. We call it the Franken-Dodd Act because of the way it's changed everything in our industry. Now let me talk about the new, what's going to really affect us as a mortgage company. Obviously now, moving forward as of October 1st, if the rule does get pushed out to then, we are now responsible for the CD, closing disclosure, and the settlement statement's gone, right? Is like my card here. So thank you very much. So we, as a mortgage company, now have to take responsibility for all those changes. So I think the biggest impact is going to be the communication lines between mortgage companies and title companies, and that's why I think it's so important for you as a real estate agent or as a loan officer or whatever it may be, that you're working with a team of closely knit people who already work together. Make sure your loan company is working with your title company. Make sure your title company already works well with your mortgage company, because you don't want that relationship to develop. You want it to already be there so those communication lines are over. So I think that's probably the biggest impact it's going to have. It's the communication we're going to have towards the end of the process.
Sure. Kayleen, same question to you.
It's the communication, like John was just saying. Making sure everybody is on the same page, that everybody knows what's going on, when it's going on, and just how it's happening. That's probably going to be the biggest, I would say, hurdle, is everyone getting used to being able to do that. The 3-day is going to be getting used to everyone getting everything ready. You want to make sure everything's done almost a week ahead of time. So just preparing borrowers, preparing the realtors, preparing everybody for what is going to happen. So that is going to be a huge impact in the sense of we kind of have to change how things are done. Just making it a little more streamlined. And so the overall aspect, if we can communicate and if we can keep on page with everybody, it's going to make a huge impact later on, and it's going to make a smoother process transition for everybody. So.
And I would also just like to comment a little bit more on that too. Everybody's a little bit nervous about the timeline, especially on the initial loan applications and the truth in lending or the new loan estimate that's going out. As mortgage companies, we already deal with this on a daily basis. We're already required to put out a truth in lending, which is exactly what this is. We're already dealing with these timelines. We already send a truth in lending out towards the closing date. And if we miss that, we still have to wait 3 days after that. Right now, we've been dealing with this for a number of years already. So I think it's just about how you look at the process internally in your office. So these aren't new problems we're going to have to do. They're just a little bit different.
And folks, the timeline that we're discussing is on the back page of the first page of your handout there. Don, what will be the most significant impact for the title industry starting out?
I think that it will be as part of this preparation that has to occur to do the disclosure 3 days ahead of time. We'll end up doing working up files and closing files twice because we'll have to get all the information that's necessary to go on the closing disclosure and collaborate with the lender regarding those numbers so that disclosure can go out again, well, in many cases, 6 to 10 days ahead of time of the actual signing of the transaction. So we're going to have to work all that up and then go back to the file 10 days later and work that up. And it's just one of the things that's a reality that's going to be there as we move forward. As John was saying, that this collaboration process is going to be very important. We are not, as settlement agents, going to prepare a HUD-1 anymore. Most lenders have taken over, while they can move it to the settlement agent and the closing disclosure, most lenders have opted not to have the closing disclosure prepared by the settlement agent. And so they are the ones who are going to prepare that. We're going to have to get that from them with that. That means not only the initial one that goes out, again, so that the borrower can see it 3 days ahead of the signing, it's also any changes. And one of the biggest changes I think that realtors have to understand is that when those changes occur at time of signing or closing, right at there, the dishwasher breaks or whatever it is, that you have to make these adjustments that are there, that's going to be a process now. It's not going to be just the settlement agent changing the numbers on the HUD-1 and doing that, everything's done, and you walk away in 10 minutes. This is a process now that has to be a communication process back to the lender. The lender may have to prepare and change the closing disclosure and move it back. So there are a lot of process changes that go along with these forms that are very important for you as realtors.
Chris?
I'm going to repeat what has been said. Communication is the biggest impact, I believe, going forward. In addition to just stronger communication, I believe also what we're finding out is technology-wise, we're going to have a lot more collaboration on systems. Who's using what system? Is it ready? How can that system talk to the other system? Because as you probably already aware, two systems do not call things the same. So it's going to be difficult to, as we're finding out, to try to mirror that and to bridge that gap as far as what does one system call a form, what does the other system call a form, how can they communicate so we have an accurate disclosure when it's time to actually disclose. So I think communication and systems are the two largest impacts we'll see.
Linda, how will it impact the realtor community?
Where do we start and how much time do I have? I'll make it very brief. First of all, there is a new form. We're going to talk about that a little later on that TAR has come up with, but we'll talk about that a little later. I think that as realtors, we're going to have to really watch what's in the contract. When it talks about HOA docs, if they're going to upgrade the home warranty, anything to do with the inspection, if you think of anything that could change the documents at closing, we're going to have to set our timeline and be prepared way in advance and not be doing this the day before closing. If you're not using the TAR Form 1925, Buyer's Walkthrough and Acceptance, I would highly encourage you to look at that form. Again, it's TAR 1925, Buyer's Walkthrough and Acceptance. Make sure that the property is in the condition that it's supposed to be prior to closing and not going over the morning before of closing or the night before closing to make sure, because those are things that could delay the closing. So anything that could change the doc, if it's a mail out to either party, make sure that they know. And I think everybody's touched on this with communications. We're going to have to be better communicating with the other agent. Good news, right? And again, there is a new form, but we'll talk about that a little bit later.
Thank you, Linda.
And I'd also just like to add to that in those things that can change that may not even trigger a 3-day redisclosure of the CD still could delay you at the closing table. How many times have we had borrowers sitting at the closing table and have to wait an hour more than they should because one small thing changed? You have to wait 3 days, but you do have to wait for the title closing agent to talk to the lender to make the changes on the CD to get it back out to you, even if they do fall within the category of not triggering a new CD itself for the redisclosure. So just be very aware that even things that don't trigger the 3 days could delay you at closing, and you don't want that bad experience at the very end for your buyer.
Good point. All right, well, let's jump into the, here's your phone number to text questions to Roxanne, which we will address at the end of the conversation, if you want to write that down. But let's jump right into the loan estimate. And John, I'll direct this question to you. Walk us through the new loan estimate and tell us how it's different from the GFE. And I'm going to put a slide up here. Wow, there we are.
Do I need to hold it up so you can see it?
It's on the second page of your packets. There it is. Great.
First of all, the loan estimate, like I said earlier, this is, I think, one of the things that they did get right when it comes to the consumer knowing what is actually going on in the transaction. This is a lot more clear to the consumer. We, in the real estate business, deal with this on a daily basis, right? So we get to know these forms a little bit more. Could you imagine somebody that only buys a house every 5 years seeing some of the forms that we deal with right now and having to completely understand them in a few minutes. So this makes it a lot more clear. One of the things I mentioned earlier is that this new form actually has very clearly marked if the loan is locked or not. And on the page 1 at the top right-hand side, it actually is very clear, your loan is locked, yes or no, until a date and a time. It can't get any clearer than that. So there is no misconception of when loans are locked, when loans are not locked. It's right there on the good faith estimate where it should be. Also, your interest rate is on there too, and your loan amount, and your monthly principal and interest. The good news is that unlike the current GFE that just has the principal and interest plus the mortgage insurance payment, not taxes and insurance, if you turn over a page, it actually has all that information for you. Maybe it's on the 3rd page. Nope, it's on the 2nd page. It has the actual payment on there for you with taxes and insurance. Then what are some of the other changes that are happening? I'm sorry, it's on page 1. What are some of the other things that they've changed on here? Obviously, there's a signature page. A lot of times we'll send out a good faith estimate, and I'll send it to a buyer to sign or to look at. They'll come back to us 2 or 3 weeks later and said, you know what, these fees aren't the exact same fees that you told me about at initial loan application. And I'll show them the good faith estimate currently, and they'll go, well, I didn't sign that. And okay, you didn't sign that, you're right. And the customer's always right at some point, and sometimes people's perceptions are different than what reality is. And a lot of times that's why it's always good to have an email backup or an actual signature on the good faith estimate, right? So I think that's very, very important that we had that on here. It also shows whether they're going to have an escrow account, which the current one does not have that either. So I think there's just a lot of good changes happening on this. The current good faith estimate also doesn't break down fees on it. This one does. Current good faith estimate lumps all lender fees into an origination fee. So this clearly outlines what all those different fees are on there. Like I said, I think this is actually something they got right. I'm so happy that the cash to close is on here. We've all had to come up with these new itemization sheets to be able to show this, and it's not consistent from one lender to another, so it makes it very confusing to buyers. This is concise. I love it. I'm ready to start using it on August 1st, not October 1st.
Thank you, John. Anything else from the panel on the loan estimate? All right, well, let's jump into the closing disclosure. Kayleen, why don't you walk us through the closing disclosure? Tell us how it's different from the HUD.
Well, obviously, the first thing you see is that it looks completely different than the HUD. And the one thing I like about it is the first thing you see is all the terms are on the first page. Everybody knows exactly what loan they're getting, what the terms are. It's very similar to the loan estimate. So it's really nice that you have everything right there on the closing disclosure on the very first page. When you flip over, that's when everything is, on the second page, you'll see the breakdown of all the fees. So that looks more of what the old HUD that we're used to. So it's all there. The only, I think, major thing that I can remember right offhand is nothing's marked as POC anymore. There's a different column for that. So it's just the way it's formatted. It's all the same information. It's just formatted a little differently. So it's getting used to. People that have been buying houses for the last 30 years, it's probably going to freak them out when they see this because this is not a HUD. So it's just preparing. It's getting used to what it is, same information and more information. So it's really good for them. Has all the transaction, going through everything that's the details of the transaction are all right there. Just the same information with the HUD. It goes through, is it an assumption? Is it not? Is it a prepayment penalty? Everything's there. So instead of having that TILA and the HUD, you have everything combined on one thing. It's very similar to the loan estimate. So it's very concise. It's very user-friendly in the sense of what they saw in the beginning is the same thing they're going to see now. So there is not, yes, exactly. It's just great. Instead of looking at one form, oh, well, what's this? Well, what's this? I mean, it's just, it's nice. All the information's there.
Don, I'm going to direct this question to you. Will realtors be able to receive a copy of the closing disclosure?
They will, either from a express instruction that I think that TAR has come up with regarding that authorization, or whether they were already able to do it in other jurisdictions as a result of privacy policy statements that a number of companies have for the disclosure of information from the client to their representatives. So yes, they will.
And Linda, do you want to touch on the TAR disclosure real quick?
Yes, there is a new form. It is TAR Form 2516. It's in your handout. I think it's like the next to the last page, maybe. So thank you, Austin Title, for including that form in your handout. And you really want to take I don't know if we want to take time to go through it right now, but basically this is a form created by TAR, excuse me, can't believe I said that, intended to be provided in their own words. TAR created this form. It's intended to be provided by the broker or the broker's agent to the broker's client for the purpose of authorizing the broker or their agent to receive the client's TILA RESPA integrated disclosure docs on the client's behalf. Separate forms should be used for each broker in the transaction. So you definitely want to, this is going to be added to all of your zip form libraries by July 1.
Okay, thank you. Let's get back to the closing disclosure. And Kayleen, if you will, walk us through the timeline. When do the documents need to be delivered? What's the waiting period, et cetera? And it's on the screen there for you.
So typically, what's going to happen now is everything has to be done. There cannot be any APR changes, anything changed 3 days before closing, which we do have that now. So typically, the major difference between now and what's going to happen is we don't necessarily have to redisclose anything or have anybody sign anything or have it acknowledged 3 days before closing. So that's the big deal. If something had happened, if an APR changed, either moved up an eighth up or down, we would obviously have to have that done and have to wait the 3-day period. So that has not changed. It's just now we have to do it on every file regardless if there's a change. We have to have this disclosure done 3 days beforehand. Now, 3 days before that, it has to be, if it's being mailed, we have to have it 3 days before that. So what we're trying to do, or what's happening, is anything that's not hand-delivered has an additional 3 days. Yes. So, because we have to give the borrower enough time, if it's to mail, that they can receive it. And then your 3-day waiting period starts. So, I don't know too many people who are going to use the mail service to do this just because you're losing 3 days. Most are going to be using a secure email so you can have a receipt. Typically, your 3-day waiting period starts when the borrower receives the email, acknowledges the email, not when I send it. So that's one of those things. So the borrower has to be very aware that when you get an email from me, you better open it, or else we're going to have a problem. You're not closing in 3 days. So that's going to be a big change. Is that our bank is setting up where we can have that secure email to have a return receipt, so everybody knows when the borrower actually received that closing disclosure, and then your 3 days. So everything's going to be secured, time-stamped. So that way we have that 3 days, and that's when it starts clicking. If you hand deliver it, that's when it starts clicking too. The big deal is if you mail it, you have to add 3 days. So just don't mail if you don't have to.
One comment on that. When we use the term closing, and you'll see the term closing on the front of the closing disclosure, a closing date, that does not mean closing date. You'd think it would, but it doesn't. Closing date is actually defined there under the rule as the consummation date, which is, in parlance, the signing date, the date that the borrower becomes obligated on the loan. So when we're talking about 3 days, it's 3 days from the signing. So if you have a period of time between the signing and the actual closing, now you're talking about being even further out than 3 days with that. And with the delivery period, could be even more. So that one term on there, it's very important that you're not confused. The closing date doesn't mean closing date for our purposes, at least here in Texas.
And I would also like to add something on the closing disclosure. Just want to give everybody a heads up that once the consumer receives that closing disclosure, be prepared for a phone call or an email asking to please explain why their total interest percentage, which is the tip, is not what their interest rate is. Because on this example, it's 69.45%. So when they read that, they're going to be pretty shocked and they're going to contact you. So you'll have to be prepared to explain how to get to that figure, which that's a whole other discussion on how to get to that figure. But so just a heads up on that one.
And I also wanted to add, I'm hearing a lot of things here. So let's just back up for a second. Let's talk about terms that we're never going to use again, right? Settlement statement HUD 1 is now the CD, our closing disclosure. So there is no closing date anymore. Now it's consummation, right? Like we're getting married. There is no more POC, right? No more paid outside closing. There is now, what is it? What did they call it? Can't remember, but there's no more POC on here too. There's no more good faith estimate. Now it's a loan estimate. So we're actually going to have to change our vernacular moving forward after October 1st. So everybody, we'll probably send the terms how to talk in real estate here afterwards.
And Don, I'm going to ask you to define business days moving forward.
You know, you'd think that, again, a term like business day could mean business day, but it doesn't. And it depends upon which document you're dealing with for a business day. They talk about it being those business days for the loan estimate and delivery of the loan estimate and all the things. Once you're in the loan estimate environment, it involves when the bank is or lending institution is open for business. So it could include Saturdays. It would not include certain holidays. For the closing disclosure, in the 3 days there, we're talking about being Monday through Saturday, I'm sorry, and no, except for Sundays and non-federal holidays that are listed. So there is a little bit of a difference, not a real big difference in there, but that's how they define business days.
Thank you for clarifying that.
So make sure your mortgage company's open on Saturdays. That's probably key here, and late. Without Sundays.
John, I'm going to go back to a point that you made earlier. You know, per the new rules, lenders are now going to be held responsible for their service providers and their failure to follow CFPB requirements. So how is your company handling this issue? Are you vetting your service providers, and in what ways?
We're completely ignoring that aspect of the rule. Actually, we already deal with that. We're dealing with it the same way we deal with the current list of providers that we have. We contact them. We make sure that they have their current policies and procedures, their quality control in place, so we know that who we're putting on there is doing things the way we want them to do it.
Sure. Kayleen, anything to add to that?
No, we're doing the same thing.
Yeah.
We just want to make sure the people that we're working with are doing exactly what they're supposed to. We
Sure.
don't need them doing something that's going to bite us.
That's right. There's an internal vetting process they have to go through, just like anything.
Sure. On that subject, Chris, I'm going to direct this question to you. You know, we're hearing that there's going to be some pretty steep fines for creditors who fail to comply with the rules. Talk a little bit about that. You know, we've heard instances, and I think there was one in Maryland where there was a $38 million fine thrown out. Talk a little bit about some of the fines.
And this is our favorite subject, right? Enforcement. So in a nutshell, $5,000 for each single violation per day, $25,000 per day for each violation that is a negligent or a reckless, however they define that, which is subject to interpretation as well. And the big kahuna, which is the elephant in the room, is the $1 million fine that can be imposed for actual intentional violations. So in a nutshell, those are the big ones. But the other important thing we need to remember as well is, since the closing disclosure and the loan estimate, which is TRID, also combines the TILA and RESPA enforcement violations. TILA comes with private right of action and attorney's fees, as with the RESPA has enforcement action. So theoretically, if you violate TRID, you could be faced with private right of action. So you have a lawsuit coming on, which you have to pay for attorney's fees, and then also you have the CFPB or other regulators can have an enforcement action against you. So it's very, very serious and very steep cost to messing something up.
CFPB has had the authority to enforce RESPA rules for years now, but we're seeing more and more violation notices by them lately. Do you believe CFPB is changing the landscape of how we do business? And are there specific things that we in the real estate business should be scrutinizing within our own business? For example, marketing service agreements, preferred vendor status, et cetera.
Right. I think the overall, our overall climate is changing in regards to, we have to be more careful. We have to know exactly what we're doing, exactly. We need to know who we're dealing with, not only from the client side. You have to also know who your partners are with, or what do they do, how do they run their business. You have to know that. And as far as the actual, the enforcement, it's important to understand the enforcement hasn't grown as far as the ability to enforce has always been there. I think we're seeing a lot more enforcement now because, to be honest, the budget of the CFPB has grown, so they're able to do more things and reach more people. So that's where we're headed, and there's no end in sight as far as I'm concerned. I think we've only seen the beginning. But as far as what we can do, I would say the biggest thing we can do is to make sure that we make sure we vet all the partners that we deal with. I mean, thoroughly vet them as far as know what their best practices, know what their procedures are, find out what systems do they use, are their systems ready? Back to the point I made earlier regarding technology, because that is a big one that a lot of people are starting to talk about. Know that, and then also, and I know this may not be a popular suggestion, but I would definitely suggest to rein in your lending and title company partners that you deal with to the ones that you can truly trust, because at the end of the day, real estate brokers, settlement agents, lenders, title companies, we all, and doc prep attorneys, we all can be liable at some point. So we want to make sure that we protect ourselves from any kind of exposure. So I would say to definitely try to rein in how many people you deal with. But at the same time, you need to be careful with that as well, because you don't want to steer the customer as well. So it's kind of a fine line where you have to learn how to do that. Which what I have been suggesting to others is to talk it over with your broker to find out if there's scripting that they can come up with. That way you can not cross the steering line, because you really don't want to go there either, because that you can have some serious impositions with that as well.
Thank you, Chris. So Linda, the majority of our audience are realtors, so talk a little bit about the changes you're making in your business as a realtor to prepare for the new rules.
Well, obviously, there's a lot, and I think, number one, we've got to educate our clients. We've got to be careful, if we're in multiple offer situation, for example. I know we want to say, hey, we can close in 30 days, look at us. Then you're going to have disgruntled clients when that can't happen, and especially if it's closing in October, for example, when all this is brand new. So we don't want to open ourselves up for liability by making promises that we can't keep. So we need to rely on our creditors, right? That's what we call them now, not our lenders.
Right.
We need to rely on our creditors. If they tell us in that particular client's case 45 days or 60 or whatever it is, because of course we're all getting them pre-approved, right? So we should know what we're looking at, and just be careful we don't cross that line making promises we can't keep, whether it's multiple offers or not. Especially if you have an FHA seller, a seller who has an FHA loan. What happens if you promise them you can close it in 30 days, and you say, we'll get this closed October 30th, and it goes into November, what happens to that seller? They pay for an entire month of interest, don't they? It's not prorated. So those are things that can get us into trouble, and, you know, I'm always one, as an educator from that standpoint, of saying, what can we do to avoid liability and making promises we can't keep? So we need to rely on our creditors to educate us so that we can then educate our buyers and our sellers, definitely. TAR offers a course on contracts, everything you want to know about contracts, something like that. Probably be a good idea for all of us to take those classes and get up to speed on looking at our contracts. When did we say we would get the HOA docs delivered? When did we say we would do this? It's not just about the option period and when it expires, but all the other responsibilities we have. And I tell you, in case studies, TREC looks at both of us being responsible. Let's say the contract says the seller is to deliver within so many days. Say it's a condo doc or HOA doc. If the seller or their seller's agent does not perform, TREC will often hold the buyer's agent liable as well, saying, you know, you knew what the contract said and you didn't do a good job of keeping, you know, in terms with the contract. So for that, so a lot of education. Thank you. And I think it really all boils down to that. I've been a firm believer that we are not salespeople per se, but we are educators. If I educate my buyer or my seller and give them enough information, they'll make the right decision for them. And then it's my job to be up to date on what forms to use, what creditors to use, what title companies to use, and to make sure that it goes smoothly from the day I meet that client until we get to the consummation.
You know, Linda, I take that even one step further. I think we're the leaders in the transaction, right? We're leading these people from point A to point B, and I think a lot of us sometimes lose sight of that leadership aspect of walking people through a transaction. I think it's very important.
You know, people start their search on the internet. I think 85–90% of them do, according to statistics, but they rely on us. They don't do this for a living. They don't know the procedure, and we need to be educating them on step by step, what from beginning to end. And Austin Title, for example, if you haven't been to their offices and see all of their wonderful handouts, we don't have to know all this information. I don't care if you're a brand new agent. Walk into Austin. I teach over there at the MOPAC, North MOPAC. Every time I go in there, I walk out with a stack of wonderful handouts for my buyers and my sellers. And put that in part of your packet and educate them. It's really easy for us to do that. Just go get the packets and read them yourself and pass them out. But again, we just need to be careful, you know, in the beginning especially, of not making promises we can't keep, I think.
Thank you, Linda. Don, anything you want to add on things realtors need to know before October 1?
Yeah, there are quite a few things. The one thing I think one of the most important is the one place, John, I might diverge with you on the cash to close. I like the concept. We'd been arguing for it for years to have cash to close on a preliminary form that the borrower could see how much they have to bring into closing. One of the problems where I think CFPB got it wrong is, unfortunately, in our own industry, and that is in the title insurance industry, on how premiums are disclosed on the form. The number that you see on both the loan estimate and the closing disclosure are not, I emphasize, not the premium that is being paid by the borrower for either. Now, here it's not going to be the premium when you see the seller's disclosure. It's not the premium for the owner's policy on there, and it's not the premium for the loan policy. Why? Well, because CFPB has to do this on a national basis. In a number of other jurisdictions, or in some other jurisdictions, let me put it that, probably all around the beltway of Washington, D.C., you don't have the more automatic nature of getting an owner's policy for the new buyer in connection with the transaction. It becomes optional, something we really didn't like to see either in there. So in there, if you were to see that, either of those numbers, they would not be correct. It's one of the main reasons that you'll also see in your packet here a closing statement. And that closing statement does show the actual numbers. It shows, pursuant to regulations from the Texas Department of Insurance, not only the correct premium numbers, but also the disclosure of endorsements and other things that are required to be on there. So does show the actual numbers. So now you have two forms. Your borrowers and your buyer is going to get both forms. They're going to get their closing disclosure that shows at least one inaccurate number, and that is for the loan policy. And they're also going to get a form from the closing agent that's a closing or settlement statement. There should be only one difference on those forms on the numbers that add up, and that should be that number there. On the closing disclosure, you will likely also see an adjustment number that brings it back to actual, and that'll be over on page 3 under the adjustments section of the closing disclosure. So there are some things there that your borrower is going to be asking you about why are these numbers, if they look at it, it's going to be what are the differences and why. Now you know that those are going to be different.
Can I ask you a question?
Let me just finish
go
off with now as to the cash to close. The real problem, and John, I don't know if you look on the screen here, this is the one on page 3, at the top of page 3. There's a cash to close comparison chart. And it shows what's on the loan estimate, the cash to close from the loan estimate, what they just saw then, and what you see on the closing disclosure. In other words, truing up this cash to close concept when you get it. One of the problems is if the lender at the beginning of the transaction does not show that adjustment there. Here, this one, do you have the slide before that? Oh, right? Nope, go back. There you go. So here you can see the cash to close, and this is just the impact of title insurance. There's going to be lots of other numbers on there. You would show, because of the way CFPB decides that you need to disclose that loan policy, which is the full premium, as if there wasn't a simultaneous issue with an owner's policy. It's going to show the borrower paying $1,650. At closing, we're going to make the adjustment, and that adjustment's going to bring it down so that the borrower is paying $100, which is the simultaneous issue premium under Texas regulations, okay? So you can see the difference in cash to close, almost $1,500 there.
Yeah, and
Sure.
the current GFE does that already, right? It
does
has
not.
the same problem as
Well,
well.
no,
because it has the total title insurance.
The current GFE would show the actual dollar numbers. It won't show that number, that total number as being increased.
So you're saying that we're not allowed to show the seller credit on the initial
No,
loan estimate?
no, you can't. You
Right.
can't. It's whether lenders, and this is where there might be a difference between lenders.
Because you and I talked about this, one of the things that we're going to be doing as a company is we're going to be reaching out to, say, Austin Title at the beginning of the loan process and give them
Yes.
an access to our portal so they can actually go in and put their title fees into our portal, so our initial loan estimate is more accurate, I think.
I think that's a very good idea.
Right.
When you do that, when you have the information up front, this is simply a mathematical calculation. It's just a question of whether the lender puts it in there. And if the lender does not put that adjustment or credit that's going to be there at the time of the closing, at the loan estimate stage, your borrower is going to look at that and say, gosh, I'm going to have to bring in $1,500 more. By the way, this is on a transaction that's, I did it, $400,000 purchase price, $300,000 purchase price, $240,000 loan. Okay, so fairly normal transaction with this. And so if you don't see this and you see zeros there, you might want to talk to the lender and say, isn't there going to be an adjustment for this so that you can get your borrower into the correct frame of mind as to how much cash they're going to have. I mean, $1,500 is a number of things. Yeah. The other place I'd caution also, if you have a transaction in this involving gift funds. If you have gift funds, there's a special treatment on how it's treated on the closing disclosure. And it might also have this same type of an impact on cash to close. So talk with your lender about that if you have gift funds as well.
Is the $1,550 the cost of the title policy?
It is. Well,
That'd be the seller's portion that they're
No,
paying for the contract.
1650 there would be the undiscounted amount if you didn't have the owner's policy. If they only bought the one. That's the way that they require you, that CFPB requires you to disclose it. As if, remember the optional concept in some parts of the United States? If you didn't have that, then if you only showed the $100 there, then you'd have a huge increase if you didn't buy the owner's policy. It'd increase to what it would be without an owner's policy. So they've opted to, and I understand that, how they want to disclose it. But in places like Texas and about 28 other states, where it's very prevalent to use owner's policies, and it's very prevalent to use to where the seller pays for that policy, it creates a real problem, and therefore the adjustment is necessary to bring it back into a true state. So I wanted to make sure that you guys understand that there is this thing that's going on with title insurance fees, such that you're able now to explain them to your clients.
So where it says did this change, it says no, should that say yes?
No, because this is as if it was no, because you didn't change anything there. You just disclosed it in that manner.
Yeah, and just to maybe simplify this is a little bit more, this is where the loan officer, when he sets up the file, needs to be cognizant of if the seller's paying title policy or not, which normally is. If they are, the loan officer needs to make sure he's putting the credit in there for the title policy so the numbers are accurate. And I see this in my office a lot, and I will tell you, when you're being shopped by other lenders and you're competing for somebody's business, very fast, a loan officer learns how to do this, because it's a big incentive for him to do it, because he doesn't get the business if his numbers are far off. So we see this a lot in the office. You have to make sure you're using a very competent loan officer who understands the process, understands what the title policy is, and who's paying for it, and knows to put it on there correctly.
The last thing I'd say on the CD, we talked about it being delivered 3 days ahead of time, 3 days before the signing, and doing that. It is likely that your client's going to see more than one CD. There are going to be changes that occur just normally in transactions. You know that now you have a transaction, numbers change, okay, with certain things, okay? So there's going to be, and you're going to get, and your borrower is probably going to get one with the 3-day that doesn't have signature lines, and then the one that comes in the closing package, where they're signing all the other loan documents, there'll be a one in there to sign as well, with the actual numbers that the closing's going to occur on. So just to let you know, there are going to be more than one.
Yeah, and I would absolutely back that up. Even right now, there's probably multiple good faith estimates and sometimes tills that go out to borrowers on files. Our stance with our company is that we're actually going to send the CD out at initial loan approval. And then if we have to resend it out a couple of days before, a couple of days, 4 or 5 days before closing, we're going to do that too, to try to get ahead of the 3-day waiting period. So yeah, one of the things, if you talk to your clients and they're like, well, I keep getting this document signed or sent to me, just let them know these are part of the regulations. They're doing this so they can stay ahead of the game, so they're trying not to delay your closing. Just e-consent or whatever you need to do to make sure that they know you've accepted this document.
Any last comments before we move to questions from the audience?
Just one thing, the question was whether what things realtors need to know.
Sure.
There is a piece that I did, an article that explains this a little bit more as one of those points, that 5 things realtors need to know, and it's available for you as you go out.
And I would just say one more thing. Just remember, all of our planning here and everything that we're talking about, preparing for it, the best laid plans never survive the battlefield. So just always remember that. When it actually happens, it's going to be interesting.
All right. Rox, do you want to come up and address some of the questions from the audience? And you might borrow John's mic, unless you want to be Britney Spears for a second.
She can just hug on you.
I will have questions for you too, John, so I'll just bring it back. So many questions in the room, everyone. So right off the bat, I'm going to go with one I got several times. What will trigger a new CD and a new 3-day waiting period? John, you want to go ahead and just answer that one?
Sure. There's many things that can actually change that can trigger the CD. One of the things is, let me find my notes here, a change in the interest rate and the APR by more than 1/8. Our company stance that if the interest rate on a fixed rate goes up by more than 1.125, then we have to redisclose the CD or the loan estimate. If it goes down, our company stance is we don't have to redisclose, only if it goes up. That's one of the main things that could happen.
Smaller items, John, is there anything that's kind of smaller that a realtor needs to be concerned with that could trigger that?
You know, any of the lender fees that are on there that we have in line 802 and 801 that change, we're gonna have to redisclose on there. I mean, I'd probably defer to our attorneys down here.
I think the ones on the APR would probably be as a result of expiration of a rate lock or something like that, where a fee goes up as a result of that. The other two things could be where there's a program change in a type of loan, and that's like moving from a variable rate to a fixed rate for a period of time. That would be a program change and would require. Most of that doesn't happen in connection with that. So those are the kind of things that.
Waiving escrows, that could make it happen.
I don't anticipate that there's going to be a lot of things that will require, even to the 1/8, that are going to require an additional it's really not the redisclosure, it's the additional waiting period that you have.
It may be a better question is what are some of the things that don't affect it, right? And that would be like your prepaid interest, any of your escrow fees for insurance and taxes.
Yeah. My dishwasher example wouldn't do it.
Now the 1/8, I'm sorry,
Go
the
ahead.
1/8 is, that's a point of confusion. There are a lot of groups that believe that it's up or down 1/8 of change, and some other groups believe it's just when it increases 1/8. So I would defer, make sure you talk to the actual lender, because they may have, or to find out what their stance is, because there is, like I said, there's a split of opinion on that, just the way it's explained with the CFPB rules.
Okay, do you?
There's something on there that, let's say they do a walkthrough and there needs to be a seller credit back, is that something that's gonna have to be redisclosed through that 3-day period?
Well, two things. Remember, there's two things, a disclosure and a waiting period. It does require another disclosure.
Okay.
So you do have to true up the numbers. You'd
But
have
you
to do
don't have
that.
to do
You have to do that anyway with things. And that has to be provided to the borrower at or before consummation, okay? At or before the time they sign, okay? There is some rules regarding doing it after the signing as well. But in most lenders, even after signing and before funding and closing, you will need to have that new form out to the borrower. The real situation is, and to answer your question, it doesn't require another waiting period, okay? So you don't have to have that. The problem will be, and the challenge, let me put it that way, the challenge will be the coordination between lenders and title companies to get that, because it's not in our system as settlement agents anymore, it's in the lender system, so we're gonna have to get it back, get it in there, get it signed, and then move forward.
So multiple times, or text that I received was, do we write 45 days in on a contract? What should that time be? Should it be 30? Should it be 45? I mean, I know this is, yeah.
I guess it depends on your lender, doesn't it? I think that if a lender's well prepared for this, initially, we're not exactly sure, like I said before, best laid plans. If you want to be safe for your buyer, and if your seller's willing to accept a 45-day, but even in our office and our timelines, I don't think that you need longer than a 30-day close if you're using the right lender and the right title company who are already communicating, who are already working together. If you're using a lender that is out of town, out of state, that has never heard of your title company, then you might want to consider longer closes. But if you have a team of experts that you've surrounded yourself with a mortgage company and a good title company that are already communicating, I don't see why you would need a 45-day close other than because of this reason per se, right? There's obviously other reasons when it comes to borrowers' credit, income, status, or property condition that you might need 45 days. But for this reason, if you have a good team surrounding you, there's no reason to write a 45-day contract right now.
Okay, good.
And that's my opinion.
And we agree. I mean, that's how our stance is at the bank. We're business as usual. I mean, we're going through it. We're expecting 30-day closes. And not that this is going to throw us off. But if you're going to have someone who's using an online mortgage company, chances are you probably want to do a 45-day or close. Just because we've seen it. We've seen it happen without this. Yeah, without this, it's happening.
Yeah.
Just, that's, back to what John said. You got a good lender, you got a good title company, it should not disrupt you. It should not disrupt your buyer or your seller.
One comment someone asked is, I imagine none of this affects cash transactions, and of course that is true. This does not matter with cash transactions. Correct, everyone?
That's correct.
Okay, just one real quick here.
Well, I just have the question of, you want to surround yourself with people that you really work with and trust, but then you get into the steering. How do you balance that? You're not steering someone, but you want to work with people that you know will get the job done.
Surround yourself with a lot of people you trust.
It's a slippery slope. I mean, you just have to make sure you don't just have that one or two. I mean, you're gonna have to find those good people to work with. They're out there, I promise you. We wouldn't be in the business for 20+ years if we didn't have the good people around there. You just have to find them, unfortunately.
Okay, will this be something builder lenders will have to follow since they seem to sometimes mix in their fees? Yes.
Yeah, I would say if you're doing builders or any kind of a construction to permanent type financing, this is a real challenge for lenders in disclosing this. And it is a kind of a special thing, so talk with your lenders about that, yes.
Does this mean to expect more leasebacks?
Right?
Linda, do you have a comment on that, maybe on the leasebacks, or?
It could. I mean, if we're just making promises, I think as listing agents, it's going to be a real challenge because we don't control where that buyer goes for a loan. And so if you've got a ready, willing, and able buyer and seller, and you've got them under contract, and then unfortunately the buyer goes with some online company, and it's kind of out of your control at that point. So we may see it.
Well, one other place that, I'm sorry, one other place that you may have a problem with is in back-to-back closings, where you're doing things. Remember, you're now going to have to time two transactions to be the same. It's going to be a challenge, at least initially. Once we get going with it, I think it'll be fine. But the initial challenge of doing back-to-back closings is there. As to the 45-day thing, I guess my thing for consumers would be put it at 45 days at least initially. Give you a little bit of extra room. If you close in 30, you can close in 30 and then do it. If you move out of contract with that and the seller cancels the contract as a result of that, that's a problem for you.
Well, that kind of leads me to the next question. Will the 3-day extension give the buyer, seller an out? How will it affect earnest money? Wow.
No, I would think that if you have the contract, it's a real estate contract, and it has a closing date in it, and if you don't close on it before that date, that's a problem. Just because there's a federal law that requires a disclosure period I don't think is going to save you.
I would just say that currently, if there's a till violation, you have to wait another 3 days too, and we've seen it in the marketplace, and that does not excuse the contract whatsoever.
Does this new rule apply to all types of loans like investor loans, owner finance, or even hard money lending?
It does apply to any, there is an exemption from it, and it's really the TILA exemption that's already been there. It's generally if you do 5 or fewer loans, so virtually all lenders are going to be there. One of the things that came up was regarding owner carrybacks. And when you're doing that type of thing, and if you have a number of properties and you end up doing 5 transactions where you took back loans, whether you are now into this new rule, and that's still the jury's still out on that one. But generally, anybody you're dealing with that's in the commercial lending business is going to be in there.
One exception that is out there that you want to make sure you're clear on is the mobile home exception, but it's in regard to mobile homes that are not affixed to land, that are not considered real property. So I've already heard a few folks that confuse when they see the mobile home, they're like, well, okay, so mobile homes are exempt. No, it's the ones that are not affixed to land, which, most lenders will lend on mobile homes that are affixed to land. So you want to make sure that you don't get that confused.
Will a change or correction of a buyer's middle name, this is just an example, obviously, at closing trigger sending back to lender and for a new TILA or?
I would say that it's going to have the title agent stand up from the desk and go into their office, have them contact the mortgage company while everybody's eating cookies at the table, and have them change the closing disclosure and go back, and that's going to affect all of our documents.
Yeah, I think that at least initially, lenders are going to be very cautious about changes and going to want to make, including middle names and things like that that are there. And then as time goes on, I think there'll be a certain amount of leeway that is provided to settlement agents to make changes that are in there. At the beginning, there will be no changes that the lender will authorize the settlement agent to make. It will all be done with the lender's approval.
I love this one. Who monitors the CFPB to protect from wrongful or overly extreme penalties?
They have no oversight.
No, they really don't. There is some congressional oversight, but it's fairly minor. They are out there somewhat unregulated. It's the reason in Congress there are some bills to reform and how CFPB is regulated, themselves regulated.
And so far, I believe, and if I'm mistaken, please correct me, but so far the bills that I've seen have all failed. So there's that.
And likely would never be signed by the current president.
Are there any conflicts between state and this federal guideline of these new rules for us in Texas, especially pertaining to interpretation for title? That's somewhat of some things you've already kind of gone over, Don.
The federal regulation does not, preemption is the concept that federal law supersedes state law. And there is no preemption in this rule. Therefore, a lot of the things like title fees and things like that, they have to be disclosed in the way they are, but that doesn't prohibit there being a disclosure of it in some other manner at the state level, which is why you have the other settlements or closing statement in your forms. So no, there's nothing in that.
So buyers will see they have 10 days to shop for the loan after an original loan disclosure. John, do you want to just say something?
I mean, I guess buyers always have a choice to shop around for whatever mortgage they like, right? I mean, I don't know if that pertains to a credit pool, if they have a time where they can go have multiple credit pools without it only counting as one. I'm not really sure what the question was. Yes, people can shop, but there's no 10 days.
Okay, this is the last one. On page 2 of the loan estimate, under calculating cash to close, and I don't know if we want to get into all this right now, actually. Maybe John, look at that. Does deposit equals earnest money, and why is the identifier different than saying the earnest money?
Oh, is there a new term we have to use now?
And if that's something, we could always follow up on some of these questions as well on this one, because I have your phone number, and John can contact you directly. Yes. Did you have a question?
Yeah, I think it's safe to say that there are unintended consequences that are going to occur because of government regulation. And to quote Wayne Gretzky, that famous philosopher, if you want to be a good hockey player, you skate to where the puck is. If you want to be a great hockey player, you skate to where you anticipate the puck's going to be. So I think the question is, and I'll share a nugget with everybody in this room this morning that just recently happened. Going to close a loan, it was scheduled to close on 5/27. Unfortunately, the seller extended to 6/8. The title company, not Austin Title, called for the payoff for 5/27. On 6/1, the seller makes the payment. The lien holder did not refund, refused, and remixed the numbers. The title officer could not get the payoff and the closing of the HUD until the day of closing. And I've talked to 3 different compliance people, and I got 3 different opinions on if this would delay it. Okay? So now these are unintended consequences that have to occur. I think the gentleman, the lawyer, for anybody to say we're going to close this in 30 days would be a mistake. Because if you have to go back to your seller and then explain, and you know, the problem is if the agent doesn't know these things, then what's worse, to know or not know? So this really is a matter of corroboration. of communication between the realtor groups, the title companies, and the lenders to come together. You know, it's not whose fault is it? It's not who's responsible. Let's get it done with communication. And what I would love to see is a forum where everybody that is in this business could cooperate and give these examples that will be the unintended consequences of what's going to go on for all of our benefit. Thank you.
And I would say I agree with you, absolutely. But when I was saying they close up in 30 days, I think that my out for that was if it's because of this disclosure process, right? If it's, there could be property issues, there could be title issues, there could be payoff issues. Those are things we already deal with on a daily basis when it's coming to closing a loan. But in the whole scheme of things, it's just because of this disclosure, should that delay it? And that sounds more like a seller side, and I don't believe the seller side has anything to do with when the 3-day disclosure goes out in this case. Yeah, but it would have been disclosed probably with an well, I don't even know if you have to have the seller, you have to have the seller information on the CD? The seller side?
The seller, actually, there will be a separate form for the seller's side that is a the seller's closing disclosure. And it does not have the 3-day waiting period that the borrower side
Right.
has.
So yeah.
Yep. This is my last question, and I got it several times, so I just want to make sure I ask this one. Does getting the buyer pre-approved help the process or no effect, or how does this affect pre-approval? Do you want to start, Kayleen?
It helps it just the way it helps it now. I mean, it's not, we want them pre-approved. You want them pre-approved, we want it pre-approved. Everyone wants to know what's going into this, not wasting your time, not wasting our time, and not wasting their time. So, I mean, it doesn't hurt it by any means. I mean, they need to get that pre-approval.
Are there any changes to that pre-approval process through this, or
Not
it's
for us.
been the
I mean,
same?
we're not, you don't have anything, do you, John?
Yeah, no, same here. I mean, there's if it's a real pre-approval, make sure it is, right? No, there's no differences right now than what we're doing.
Okay, I'm going to hand this back over to Josh or Beth here. We've got a drawing. I think what we've all learned today, one thing too, is communication key or what? Absolutely. So come on over. Got it, Josh.
I want to thank everyone who carpooled today. You should have put your cards in for a $100 gift card to Galaxy Cafe. So Barb is going to draw 3 winners, and you must be present to win. First winner, Brandy Guthrie. Is Brandy Guthrie? All right. $100 to Galaxy Cafe. Terry Doggett with UFCU. Is Terry still here? Terry Doggett? All right. Next drawing. Scarlett Sattler with Star Homes Realty. Is Scarlett still here? All right. Oh, last one is Blanca Zamora Garcia. All right. Thank you, everyone, for coming today. We really appreciate your attendance.
Thanks to all of our panelists. Thank you for being here.
That was great.